24 seconds away from the opening bow this morning. Good morning. Here is the price action. Slightly negative. We're off the lows. We're down about 7/10 on the S&P 500. On the Nasdaq 100, down about 0.9%. After the close on Thursday, we were looking to squeeze out a fifth straight week of gains with the S&P up by about 0.1%. We're going to take out that week of gains this morning at the opening bow. That is the opening bow. Switch up the board and get to the bond market. Yields look a little something like this on a 10-year higher, much higher, up 8 basis points, approaching 3%, 296.66. Dollar stronger, eating up G10 this morning. The US dollar, euro weaker, euro dollar negative 1/3% at 10057. And crude bouncing back. We reclaim once again a $90 handle, a 90 handle on WTI. We've done that a few times over the last couple of days. $90.71 on WTI. At the opening bow, let's get you some moves. We can do that with Katie Greifeld. Hey, Katie.
Hey, John. Well, let's kick off with General Motors. It's getting a little bit of a lift this morning after reinstating dividends and buybacks after a 2-year pause. The automaker will now pay out a 9-cent quarterly dividend. It was 38 cents all the way back in April 2020, but still good news. Deere, though, not so much. The machinery maker cut its full-year outlook this morning, thanks, of course, to the supply chain. Earnings also took a hit from higher expenses and production inefficiency. You can see shares down by more than 2%. Moving down the board to some of the more speculative corners of the equity market, you have MicroStrategy falling about 6%, on track with Bitcoin's 8% drop or so. MicroStrategy still your best proxy for crypto moves in the equity market, even though Michael Saylor no longer CEO. And finally, Bed Bath & Beyond. I know Taylor's going to dig into this one in a little bit, but just know Ryan Cohen completely exited his stake after just 5 months. Those shares down just a stunning 40% or so. I
like how diplomatic you are about that, the slightly more speculative parts of the market. Katie, thank you, as always. About 1 minute and 30 seconds into this, we are negative by 0.6%. The one single industry group on my screen right now in the green is healthcare, up by a little more than 0.1%. Lagging right now, communication names down about 1%, discretionary down about 0.8%. As you might expect, information technology down 0.8%, given where bonds are trading right now, with yields higher, much higher. I'm told today that $2 trillion worth of options expire. The person telling me that, Abigail Dillittle. Hey, Abby.
Well, John, it is a big day, and at this point, $2.1 trillion. It's getting even more larger in the possibility for some volatility as this expiration happens. And many thinking that with the expiration, with all these options expiring, that it could also be the expiration of the 2-month rally we've seen. Now, when we break it down a little bit, the S&P 500 futures, that's the biggest piece of it. Single stock, another big sleeve. And then ETFs, the E-minis. So in any case, lots of options as we're talking about expiring. In fact, Kevin Kelly over at Kelly ETFs, he is saying that we could see volatility pick up in the next few days as this does expire, as this expiration happens. What we're looking at now is the put-call ratio, and you can see that it's been going down. That tells you, this is the open interest, that tells you that the volume on puts has been declining, which is kind of a head-scratcher given what we've had this year. But over the last 2 months, as we've had this rally happen, you can see puts going back up. So folks are hedging. And this, as the VIX has gone below that key 20 mark for a little bit, now back above it. One point to make there, John, and you can see it, that year-to-date uptrend has been broken. So it's unclear whether or not we're going to stay in complacency zone or up. But one thing I can say from hosting Options Insight every day, one key measure for volatility, a lot of folks are saying that it has less to do with options in some ways in the VIX, but it's the Fed that is driving all the volatility. So all that Fed liquidity suppressed volatility, now that that's coming off, we're starting to see real volatility.
Even doubt blame the Fed. That is the theme of this show, as you know. Abby, thank you, as always. One stock to watch, Deere, down about 3.8%. Both Deere and Ross Stores, both missing estimates this morning. Deere cutting its profit forecast. Ross lowering its EPS outlook. The retailer CEO saying the following: we're facing a very difficult and uncertain macroeconomic environment that we expect will continue to strain our customers' discretionary spending. Taylor back with us for more. Hey, Taylor.
Could we blame the Fed for that, too?
Of course we can. Just blame the Fed,
There
Taylor.
we
Carry
go.
on.
Well, here's the good news. Deere isn't doing that, but like you mentioned, sort of on the bottom line and that full year bottom line, trimming the forecast. You're not seeing an outright cut, but you're seeing more of a narrowing. So previous estimates for full year had been from 7 to 7.4 billion, now looking at 7 to 7.2, and again, sort of costs, rising inflation, still a big story for this company. And so analysts, of course, and investors looking at that stock off just less than about 3.5%. A little bit of a similar story, I guess you could argue, is Ross Stores. I think some of the more interesting notes out from the street. BMO Capital Markets saying more questions than answers in this report, and the Citi analyst saying that it's going to be still a big drag when you think about some of the headwinds to the consumer. And in terms of some of the other off-priced retailers, he still prefers TJX and those companies, and that's actually where you can see some of the differences in all of the different retailers that we're looking at. Ross and Walmart, when you think about maybe the lower expectations, trying to get some of the inventory behind it. Target will look at maybe the last couple days, given that they reported a few days ago. But you are really seeing a mix here of people who are looking at maybe more of that grocery business when you think about Walmart, Target versus Ross, which doesn't have that omni-channel presence. A lot to digest.
Are we going to talk about Bed Bath & Beyond a little bit later?
Stay tuned. 5 minutes.
There we go.
So ready.
5 minutes away. Taylor Riggs, thank you. You know that saying, not blame the Fed, but don't fight the Fed. Don't fight the Fed. This is Bank of America. Very few fear the Fed. Think pivot and the return of meme stocks. Yeah, last time the Fed ended a hiking cycle with negative real rates was 1954. And even assuming CPI gains half over the next 6 months, whether the Fed knows or not, they're nowhere near done. Katie Lyons has more. Hi, Katie.
Well, John, does the market know that, even if the Fed does maybe know that or not? That is what Bank of America is pointing out here, and the inflows we have seen into equities, nearly $8 billion over the last week. But what I find so interesting is into what kind of equities we are seeing the flows, because after massive underperformance of growth relative to value in most of this year, that has changed over the course of the last 2 months. Since over July and August thus far, about $9.2 billion has flowed into U.S. growth funds. More than $3 billion has come out of value. And off the low since mid-June, it's been the more expensive stocks leading the way, especially those large cap growth names. Michael Hartnett also pointing out that just 4 stocks, Apple, Microsoft, Amazon, and Tesla, have contributed 30% of the rally we have seen off the bottom in June for the S&P 500, which speaks to the narrowness of the rally, but also to investors just not being scared of high multiples again, because growth stocks trade at nearly 24 times forward earnings, more expensive than the broader market, and of course significantly more expensive than those value stocks. As for why investing in growth hasn't been as scary of a proposition over the last 2 months, a lot of that has to do with bond yields, because higher borrowing costs usually are more threatening to those richly valued stocks due to the implications for the discount rate and future cash flows. So the reversal of those rates has led to somewhat of a re-rotation within the equity market. But with rates climbing higher this morning and the Fed still hawkish in the lead up to Jackson Hole, John, I wonder how long that growth rotation can stick.
Rates up, stocks down. That's the theme this morning. Katie, awesome as always. About 7 minutes into the session, we're lower by 0.6 on the S&P. The underperformance from big tech and the Nasdaq down about 1 full percentage point. Earlier on this morning, Kaylee, Tom and I caught up with Federated Steve Cheverone. He said investors should sell big tech. Take a listen.
The rally we've seen in some of these tech stocks, they're just too high. They're still trading at 25 times, and we think they've got to trade somewhere closer to 19. So we would be inclined to sell tech here, and for the time being buy defensive dividend-paying stocks outside those couple of big names that are high-quality tech. But in general, what's run is the junk, and I would fade that in favor of higher-quality equities and higher-quality bonds.
Dan Suzuki of Richard Bernstein echoing that call, running the following: buy cheaper defensive fixed income duration and sell expensive cyclical equity duration like tech. Dan, I'm pleased to say, joins us right now. Dan, awesome to catch up, buddy, as always. I wanted to start with a quote of yours. This year's sell-off has been the market's way of trying to hit investors over the head with the idea that they should avoid clinging to yesterday's winners. But few seem to be listening. Dan, why do you think that is?
Well, yeah, first of all, I mean, the reason that I was saying that is because, you know, there's not much debate about the fact that we've been in a bear market this year. There is some debate about whether that bear market is over, but putting that aside, you know, we've been in a bear market, and the one thing that you can hang your hat on in markets is that bear markets, they always signal a change in leadership. So that's telling you that you can't cling to yesterday's winners. You need to look beyond, you know, what's been working over the last 10 years, and that's not what you're seeing in the markets. People continue to go back to their tried and true investments that have worked, and that's normal, right? You saw that in the wake of 2008. You saw that in the wake of 2002, and so this is very, very normal. People have a very hard time thinking that things will change, but things are changing. People just don't know it yet.
Dan, do you think we face the prospect of a lost decade chasing old winners?
I think that's right, and it's not necessarily that they're going to persistently be bad, every year, over the next 10 years, but the starting point was so high, for these assets that it just makes it incredibly difficult for these stocks to put up really, really strong returns. So I think from that perspective, you are likely to see very, very muted returns, if not a lost decade, because for one, the valuations are so high. Embedded in that is expectations are so high. But when you come down to the reality versus those expectations, you're seeing what the reality now is that those growth rates cannot be sustained. Those margins cannot be sustained. There's going to be more pressures, like regulatory pressures, like tax pressures, like we saw this week. All these things are going to compile relative to those very, very high expectations, and I think they'll make it very difficult over the next decade.
So, Dan, where do you think the leadership comes from?
Yeah, John. The easy answer is that I don't know, right? I mean, that's what we've spent a lot of time focusing on is, where the fundamentals are improving. So regardless of my opinion on what the next decade is going to look like, we're really focused on what is in terms of what the data is telling us. Now, if I were to guess, if the last 10 years has really been about disinflation and U.S. large cap growth, my starting point is that it's probably going to be somewhat the opposite. So that means pro-inflation assets, not necessarily over the next 10 months, but over the next 10 years, pro-inflation assets, and also a little bit more international, a little bit more small caps, and a little bit more value. But again, a lot of those aspects are very cyclical, and in this slowing cycle, it's probably not necessarily the best time to be going full bore into those assets.
Dan, what I hear from you is that we're not just going back to the old winners, we're not going back to the old playbook, we're not going back to the old regime of the twos, 2% inflation, 2% growth. Do you remember that? Are we not returning to that, Dan, even after next year?
I don't think so. I think, from a secular basis, I think we're in a new paradigm, and that new paradigm is going to come with higher inflation, higher interest rates, and less globalization. Now, clearly, the more dominant force is going to be this slowdown in potential, profits recession and all-out economic recession that we see in the coming years. That's going to overwhelm the secular story in the near term. But over that longer period of time, I do think you're going to see higher highs and higher lows in terms of both inflation and interest rates going forward. And that's going to be very different. And that's a result of a number of different things, including, the sea change in globalization, the sea change in, power shifting from corporations back more toward, employees and workers, and, various sorts of commodity dynamics as well.
I remember a phrase that you shared with me in the depths of the pandemic, and it read as follows: better to be late than early. Don't chase the rally. Dan, why is that true? Why does that hold true still today?
Well, first of all, empirically, John, it's true, right? I mean, you're referencing a piece that I just put out earlier this week that just looks very objectively, at all the bear markets over the last, 90 years or so, and basically, more times than not, it's better to be late than early. In this case, we looked at 6 months late versus 6 months early. But what's more important than that, about the argument around the timing is what that being late allows you to do, what being patient allows you to do. And it allows you to focus in more on the incoming data. With more time, you get more data and you get confirmation, because the only way that you're really going to get sustainable rallies is that you get some combination of a bottoming in profits or bottoming in liquidity. You need to see some signs that those things are starting to get less bad, if not better. And time that being patient allows you to do that. The unfortunate thing for markets today is that you're not seeing any of those signs. Profits continue to decline, and my guess is that we're going to be a profits recession, by early next year. And then liquidity is going to continue to tighten. That's kind of what you were focusing on earlier. The Fed's going to continue to have to tighten. I agree with Michael Hartnett. That's spot on.
Dan, awesome to catch up. Dan Suzuki there of Richard Bernstein on the later.
Thanks, Sean.
On the latest, don't chase the rally. Seems to be the message from Dan. That phrase in his latest research is something I remember he told me a few years back as well. Better to be late than early. Equities right now down 0.8% on the S&P 500. On the Nasdaq, we're down about 1.35%. Talked a lot about what's been developing in the bond market. Yields in the UK, in Germany, across Europe, in Italy as well, higher, much higher. That bleeds over stateside too. The 10-year up 8 basis points to close to 3% at 2.97. Your 2-year up 7 basis points to about 3.27. Coming up, the meme stock craze continues. Bed Bath & Beyond plunging once more.
What we're seeing is a lot of option plays that we saw in Bed Bath & Beyond, and GameStop, AMC. But again, everything's being dealt a hedge. So if you're hedging, if you're a market maker, you sold an option, you're offsetting that trade in the equity market.
Less stock down and down hard. We're off by 41%. The latest coming up.
What we're seeing is a lot of option plays that we saw in Bed Bath & Beyond, and GameStop, AMC. But again, everything's being dealt a hedge. So if you're hedging, if you're a market maker, you sold an option, you're offsetting that trade in the equity market. That activity is actually, the option is translating into the short and long part of the market due to the dealt hedging of the stocks.
Bed Bath & Beyond plunging yet again after its second largest shareholder cashed out his stake. The stock recording its biggest intraday decline on record, dragging other so-called meme stocks down in sympathy. That name is down 42%. Taylor Riggs has more.
For perspective, coming up into this, pretty much every day in the last month, John, it was 10, 20, 30, 40% gains every single day. But again, a lot of news in the last 2 days, which means you see a 20% drop yesterday and a more than 40% drop today that you just mentioned. So given a big run up, you're still looking out in 2 days alone, more than 60% drop. The why behind this, you may not have fundamentals to the upside. We certainly have some fundamentals to the downside. RC Ventures, we know that that was backed by Ryan Cohen, sold, and he was one of our larger investors, sold that stake to zero. Got a good profit, $68 million. But again, some questions about the timing. And again, what does it mean for a strategy, for a real big turnaround story that was supposed to be Bed Bath and Beyond? Finally, of course, I mentioned sort of the long-term picture here and the decline that today represents. As you can see, wiping out a lot of these gains just on today and the last 2 days alone. I could do meme stocks longer. I think we'll leave it there, but I just think sort of these big questions, as always, are just the timing and really what it means for some of the other traders who got involved and really had high hopes.
Taylor, awesome coverage this morning, and looking forward to the coverage a little bit later at the close, of course. Taylor Riggs with Caroline Hyde a little bit later on. We're looking at the more speculative parts of the market where the volatility typically lies, crypto. Looking at Bitcoin down by a little more than 8%. Kelly Lyons has more. Hey, Kelly.
Hey, John. Well, in crypto, an 8% move isn't realistically all that hard to come by, and yet it definitely is a decisive move downward for Bitcoin today. We are back below that $22,000 level. One thing I have noticed after watching this space for many months now, John, is that Bitcoin is really, really good at getting stuck in ranges. First, a couple months ago, we were in the 30,000 range. Now we've been hovering in the low 20s, made some gains since mid-July, but really now giving all of that back due to the fact that this market seems once again to be focused on a higher Fed, more hawkish Fed, and really just risk sentiment overall is getting depleted, which is why you are seeing crypto taking it on the chin today. And as Bitcoin prices go, pretty much all crypto-related equities go with it. The likes of Riot Blockchain, Marathon Digital, MicroStrategy, which is really a Bitcoin proxy, given how much of the cryptocurrency it holds on its balance sheet, Coinbase, the exchange, all down in the range of 9 to 11%. And just to give you an idea of the kind of activity taking place beneath the surface, according to CoinGlass, about $220 million of crypto positions got liquidated in the span of just an hour earlier today, and Bitcoin equated to roughly half of that. One note I would say here, John, is that really you can expect Bitcoin to basically go the direction of the NASDAQ 100. Risk sentiment is sour and it weighs on equities. By and large, it's going to weigh on Bitcoin as well. Really, since the pandemic era began, that correlation between Bitcoin and the NASDAQ 100 has been very, very strong, John.
Kelly, thank you. And Kelly, thank you for everything this week as well. Double time with Tom Keene and I. And I said thank you for tolerating us a little bit earlier, and I meant it. So you get the promo too. Bloomberg Crypto, Tuesday, 1 p.m. Eastern with Kelly Lyons and Matt Miller. Do not miss that. Looking forward to that next week. Bit of news for you. I want to show you this coming from Dow Jones. Preparations are underway for Chinese leader Xi Jinping to travel to Central Asia to meet with, here you go, Russia's Vladimir Putin and other leaders at a regional summit in mid-September. That according to people familiar with the planning. That from Dow Jones just moments ago. I want to get you in touch with the price action more broadly. The S&P down 1%, the Nasdaq down by 1.5. Abby has the sector price action. Hey, Abby.
Hey, John. Well, you know, it seems that hitting resistance this week, the S&P 500 still below that 200-day moving average is really sticking, because right now we're looking at the worst loss. The S&P 500, as you're mentioning, down 1% since July 26th. And you can see it's the heavyweight sectors down more than 1%. Industrials, materials, tech, financials, discretionary, and communication services. So lots of those mega cap. On the upside, healthcare. That, of course, is a defensive sector, so that's not such a positive. In fact, that's what we're seeing on the week. At this point on the week, there are only 3 sectors higher. 2 of them are true defense, staples and utilities, and then you have energy creeping higher. The worst sector, that's all about communication services. Meta, Google, Comcast, Verizon are down. Interestingly, though, John, what's helping out that staples sector be on top this week? Costco and Walmart. So we've had these big retail earnings, but some of them, those discount retailers, big box retailers, beating lowered expectations, leading on the week.
Abby, thank you. If you wanted a quiet end to the trading week, you are not getting it. The S&P 500 down 1 full percentage point. Up next, we'll bring you the trading diary from New York City. This is Bloomberg.
Gordon.
We are ending a 4-week winning streak on the S&P 500 if this sticks. We're down about 1% on the S&P, down more than 1.5% on the Nasdaq. That's the price action. Here are the things you need to be looking for through the next week. Here's your trading diary. Minneapolis Fed President Neil Kashkari speaking on Tuesday, plus retail earnings keep rolling in. Macy reporting results a little bit later on in the week. We get US GDP and another round of initial jobless claims on Thursday, plus the Fed's annual Jackson Hole Forum kicking off on Thursday. And finally, a host of consumer data, Mitch, personal income and spending to round out the week on Friday. And we hear from Chairman Powell on Friday at 10 a.m. Eastern Time. From New York, this was the Countdown to the Open.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
No one covers the world like Bloomberg.
Justice says they'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Minutes into the U.S. trading day on this Friday, August 19th. Here are the top market stories that we're following for you at this hour. The Fed fights back. Fed officials ramp up Fed hike talk. Markets roll over. Dollars see its biggest weekly gain since June 2021. Yields surge. Just how scared should markets be? And rising costs steamroll Deere. The ag giant cuts its full-year outlook as demand just isn't good enough to offset rising costs and supply chain problems. We're going to speak to Craig Fuller, FreightWaves CEO and founder, to get the latest read on the shipping industry. And Credit Suisse, love it or leave it. David Harrow, Credit Suisse's largest shareholder, says it should fix its investment banker, find other options. More from our exclusive interview. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, obviously decidedly risk off. Volume is high. Yep. Is it options and technical, or is it actually fundamental?
I think it's probably a combination of both of those two factors.
clearly we're getting some expiries. Clearly there's some big levels that we're watching at the moment. 4,300 on the S&P is a massive one, apparently, according to the options people that we've been talking to. But I think there is also this Fed story that I think is growing in importance. We've been talking about Jackson Hole for a few days, Alex. I just wonder whether finally we are seeing a little bit of fear. At 7 a.m. this morning, you and I thought it was clever to have our question of the day, which is based off what Michael Harnett was saying over at Bank of America, that the market doesn't fear the Fed. Should you fear the Fed? Is our question of the day. I don't know. Maybe we're getting the answer. What do you think?
I didn't think we were that clever, but sure, yeah, we can go with it. I mean, maybe that's what I'm saying with the fundamental part, as if like we're finally accepting the fact within the markets that the Fed's going to actually do what it says it's going to do, or is this just positioning, and you're still going to be dealing with positioning issues headed into that Jackson Hole?
Maybe, yep. As I say, combination of a lot of factors coming together. A lot of people have hated this rally. I think so many people have hated this rally. Maybe there's a little bit of Schadenfreude in the market as well, in the mix as well. Well, let's try and answer the question in a smarter way than Alex and I can. We just come up with the questions. We get smarter people to try and answer them. Bloomberg's international economics and policy correspondent Mike McKee joins us. And, of course, the one and only Vincent Signorella, Bloomberg macro strategist, with us as well. Vince, any sign that the market is beginning to fear the Fed? Is that what today's about?
I think it is. I think you're right. It's a combination of both. It's a little bit of some of the talk we heard overnight from the ECB, the UK, and of course the Fed was piling on yesterday. I am in the opposite camp, to be honest, and I look at these as really great opportunities. I'm not afraid of an institution that can't get a forecast right. I'm not afraid of an institution that has been wrong for at least the past 25 years. And you know, when I was trading and they said Goldman Sachs is selling, I'd be like, I'm a buyer. There's just more for me then. Thank you. I don't think you can look at this Fed with any credibility, frankly. From the transient on, you know, we heard Daly yesterday. I think she's closer to the mark of the way this is going to play out. She's looking for 50, maybe 75. That puts us in the neighborhood of 325 for the upper band of the target. They're not giving monetary policy an opportunity to work its way through the market, which we're just starting to see in terms of home sales or home prices as well, and many of the other metrics where things are turning lower. They're not stopping at any stop signs or red lights. They're just a little too aggressive for me, and I think after September, the data is going to prove that they've been just too aggressive and they're going to slow down.
Okay, so Mike, Vincent isn't even paying attention to the Fed. It's not like he's not listening. He just doesn't care. Powell's not going to like people like Vince, right? Because they're going to need to make the markets care. How does he convince Vince?
You know, I was trying to figure out how to respond to Vince on that. And I don't think it's a matter in the markets of fearing the Fed is fearing the other market participants, because they're going to react to what Jay Powell says no matter what Vince thinks. The issue is that the markets don't know what's going to happen, and the Fed doesn't know what's going to happen. And so it's Powell's job to try to convince people that the Fed will do what it takes without being able to say exactly what it takes. And that's been the discussion among the various Fed people who've spoken over the past week. You're right, Vince, that they don't know what the impact is going to be of the rate increases they've already put in train, which is why Esther George has flipped from hawk to dove, because she worries that 18 months from now, 12 months from now, we're going to be a much slower, much weaker economy, and then the monetary policy hits. I think what they're going to try to convince people of is that they get to neutral, which is the Mary Daly position of a little bit above 3%. And then I don't know if you pause or you go back down to 25 basis points or something, but basically you stop and look around and see what's going on before you go any farther.
Mike, I think the neutral discussion is a rabbit hole that I think is causing the Fed credibility issues all on its own right now. But if, to your point about Esther George, if we get a disunited Fed at this point, isn't that going to damage credibility even more?
I don't think you get a disunited Fed. I think Esther has made her position clear. You remember, she voted against the first 75 basis point move because of the concerns about what will happen down the road, but then she did not dissent at the last one. So I suspect that she falls in the camp. Some of the other Fed bank presidents have said this, that you make your point and then you move on, and there's no sense tilting against windmills unless she really thinks it's going to be a problem. But I don't see anybody else on the Fed to this point who's voting who would disagree with what they've done so far.
Okay, Vince, that in mind, what are you doing? How do you trade? What do you do with the dollar right now?
I think what you've seen this inverse correlation between the S&P 500 and the dollar. So whenever you see a situation where we're seeing the stock sell off today, and you see the dollar pop, for me the opportunities on this trade are to fade all of these things, and I think they're all going to come back. I think the 4,300 level you were talking about is very key. That's gone as far as options traders concerned. What is really key is just behind that is the 200-day moving average for both the S&P futures and the S&P cash. It eventually, as we stay down here, those levels will come down. We'll all probably meet again at that 4,300 level, and then I think it's going to be tested. And it'll probably be tested after Jackson Hole. And if the markets get above that level and sustain that level, I think we're going to go considerably higher. I think Mike makes a very good point. They're going to go in September. The question is 50 or 75. 75 would not surprise me at all. When they talk about we need to keep aggressive to drive inflation or beat inflation, I think they're just going to be so aggressive that they beat the economy into a recession. And when they do that, and I think it's inevitable because as I was talking to a trader last week, the only soft landing we've seen in the last 25 years was Sully on the Hudson. The Fed's not going to pull it off. They're going to push us into a recession, and then they're going to find themselves even more in an incredible state where now they have to do what Esther George says, which is we have to take our foot off the gas and even perhaps cut to relieve what we've already done.
Vince, let me flip the question around the other way. Should the Fed fear the markets right now?
I think they should at least respect the markets. I don't think fear is the right word. I think what they really are not doing is listening to what the economy is saying and listening to what the markets are saying. The Fed since Greenspan has been attempting to tell the markets what to do. We've seen over 90 federal rate decisions, changes in the Fed funds rate since 1991. To me, that's overkill. I think it's the Fed trying to dictate to the economy and not sitting back and listening. It's like when you're in a relationship. If you're the one doing all the talking all the time, you're not probably going to have a real positive relationship. And I think that's the relationship the Fed has with the markets. They're talking all the time. They're not listening. And there's no unity. The markets can find interest rate levels on their own. And, you know, we don't see the 10-year at 280 when it was at 350 because markets think inflation is going to stay at 6%. Markets think that inflation number is going to come down with or without the Fed, and we honestly don't need their help. The consumer will do it because they're running out of disposable income. And when they slow down, inflation will slow down.
It's interesting. I would say you respect the markets as well rather than fear them, but the Fed feels that the markets, A, want guidance, and B, it's worked for the Fed. Jay Powell comes out on Friday next week and says we're going to do X, Y, Z. The market's going to price to that. And if the Fed feels they want to get rates higher without even having to move, all he has to do is say that, and the markets will move. So the forward guidance is not an official policy anymore, but it works. And that's what the Fed is going to look at.
Guys, such a great conversation. I really appreciate it. I also love the whole if you're talking a lot, you're not listening thing. I'm gonna take that with me, take it home with me. Vincent, thanks a lot. Vincent Signorella and Mike McKee, thank you. All right, coming up, it is that make or break it moment for bulls. We're talking about today's $2 trillion options expiration. We're also continuing to look at that 4,300 level. Joining us, Chief Strategist at Interactive Brokers, Steve Sosnick. This is Bloomberg.
this month. As the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th on Bloomberg Television and Radio.
There are some technical reasons why, as we go into this expiration, so this Friday, volatility could stay dampened. You could continue to see the market relatively supported. And that's just related to what happens every expiry season when, certain large positions expire and there has to be delta hedging on the other side. Now, as we flush that out, we have Jackson Hole next week, I think on the 27th. And I think that's your next event to watch.
That was Amy Silverman of RBC Capital discussing today's $2 trillion options expiration ahead of Jackson Hole next Friday, which brings us to the question of the day. Should you fear the Fed? Want to get another take here with Steve Sosnick, Interactive Brokers Chief Strategist, joining me here on set. Steve, it's good to see you.
Great to see you, Alex.
So it's kind of do you fear the Fed, and should you fear the Fed on a fundamental basis? And then the same, you get the noise with the options expiration. What do you think?
Well, fear the Fed, I think, I'm going to say respect the Fed. And I think the question is, the Fed, I think people are basically saying that the Fed is a bunch of wimps, that if there's the slightest bit of market turmoil, if there's a whiff of recession, they're going to back off their inflation call. I think that's a tough one to make right now. Powell, markets reacted very positively to Powell's use of the word neutral at the press conference and really saw the market zoom upwards after that, despite the fact that pretty much every other Fed talking head has pushed back on that, and despite the fact that in the same sentence he said they were going to restrictive. So I think we have to respect the Fed until the market is, I think, anticipating that they're going to blink, and it's not clear to me that they are, and that's a tough place to be right now. Today's expiration is a little bit of a different story because I think there was a real hope that among certain traders that we would push through 4,300 on the open, where there was about $800 million worth of expiring options around, and most of them were centered around the 4,300 level. The European numbers put a damper on that, and so I think today we're going to see a bit more lackluster expiration.
Yeah, 42.35 is where we're trading right now. We're definitely struggling on that front. Steve, from your vantage point, from the options market vantage point, the rally that we've seen in equities has been driven by what? A lot was made of the genesis of this rally being in the Powell pivots, fiction or not. Since then, though, it does seem as if the options market has had a big role to play in what has been happening here. Can you walk me through what we've seen and where it leaves us?
Sure, Guy. I think to a certain extent, people have really been dusting off the 2020-2021 playbook to a large extent, and that included using call options as a speculative vehicle for a lot of individual traders and aggressive institutional accounts. They reach their frenzy when you get into meme stock craziness, but in general, I do think you've seen a lot of it. And last Friday's activity, where a lot of people were very excited about a 1.7% rise in SPX, that was, I think, largely option driven because, you've all heard the phrase "don't short a dull tape," but I think that in a frenzied market, you can actually find people buying expiring SPY calls, dollar out of the money. Enough people do it, market goes higher, and rinse and repeat, and that's what you had Friday, and we've been working off that all week.
So after today with options expiration, does it continue on Monday?
I agree with the prior comments that I think we calm down a bit until Jackson Hole, when really, all bets are off to a certain extent. We don't know what they're going to say. I'm a bit concerned about the pushback element that I mentioned, but I think the options market, it is late summer. We kind of go into a little hibernation, but then September, people just always get a little freaky in September, whether it's back to school or whatever else. I think this constant 20 level in VIX may be a buying opportunity in that regard if we get into sort of a freakish little bit of autumn.
Just in terms of positioning right now, Steve, how aggressive would Powell have to be to generate a significant reaction in the equity market?
That is a great question. I think right now, I think I think he has to deliver. I think I wrote something earlier this week that markets essentially have this parlay bet on, and there's a reason that betting shops push parlay bets because they have high outcomes, low odds, and people usually overpay for them. And I think right now we've sort of got this belief that earnings are going to be fine. We're going to skirt a recession. The Fed's going to be, but the Fed is also going to the Fed is also not going to be as aggressive at tightening. Somehow they all have to pay off just right. That's a very tight needle to thread. Doesn't mean we can't, but I think right now, unfortunately, the base case is for this parlay of events that have to transpire in order to keep this moving, and that's where I get a little bit nervous.
Well, to that point, I think then it's also a positioning issue too. How much more short covering potential do you think that there is?
I think we've exhausted a lot of the short covering. I think the first wave. I break this recent move sort of into three waves. We were deeply oversold in June, and we rallied off that low. That's normal human nature. Buy the dip never truly goes out of style. It's just how small or large of a dip. Yeah. Then we had earnings where they were better than feared. Again, people were very negative going into earnings. Now I think we flipped it. I think we worked off a lot of the negative sentiment. We've gotten into positive sentiment, and that becomes trickier. Markets tend to ebb and flow, and so now if the sentiment is very positive, I think we're more susceptible to negative news than we had been before.
I figured out what a parlay bet is. Over here we call it an accumulator.
Okay.
I've translated. Now I know what you're talking about.
Gotcha.
Parlay makes more sense.
Steve, not to me. Steve, the VIX has gone sideways. Talk to me about volatility of volatility. When does it pick up? Which way does it go?
I think a lot. I do think we're going to continue to see more volatility. I think volatility picks back up. I think the volatility of volatility picks back up. We still are, until proven otherwise, in a tightening regime. As if you have central banks around the world tightening, that tends to be positive for volatility, not necessarily for the rest of the market, but it tends to accelerate volatility. That was my base case call coming into this year, and I kind of have to stick with it until or unless we really see a pivot from the Fed coming down the pipe. Remember also, quantitative tightening is just kicking in. And that's a whole other animal, and markets really have not had to deal with a Fed shrinking the balance sheet for very often in the last 15, 20 years. When it has had to deal with them, it usually hasn't gone all that well, at least in the initial phases.
Before we let you go, real quick, S&P 200-day moving average. We didn't break above it. Does that support the idea that this is a bear market rally? And if we break above it, does it change that thesis?
I think as of now, it's still a bear market rally until proven otherwise. We're still within that framework of what fits a bear market rally. Yes, it's a bit broader than normal. Yes, it's a bit stronger than normal. But again, until we get out of this backdrop, it's hard to see it. Going above the 200-day moving average would be somewhat significant, but I think we're going to have a lot of work to do until we get there.
Have a great weekend, Steve. Appreciate you stopping by and joining us. Thank you very much. Steve Sosnick of Interactive Brokers joining Alex on set in New York. Still ahead, we're going to take a look at what the recent meme frenzy means and how it's going to impact ETF land. That's next. This is Bloomberg.
This is Bloomberg.
Well, this week, if there was a theme in the market, it was definitely the meme stock mania. So let's talk about it with the impact on exchange-traded funds. Bloomberg's Katie Greifeld is with us now for ETF Friday. Katie, obviously Bed Bath & Beyond was the huge one this week. Was it also replicated in the ETF space?
It's difficult. So there are some funds out there that do try to track meme mania. You have an ETF that's literally called the Roundtail Meme ETF, only has about $1 million in assets. There's also the Buzz ETF, that is the VanEck Social Sentiment ETF. If you look at the holdings, though, they don't actually hold Bed Bath & Beyond because obviously it's such a moving target. It's hard to actually build a portfolio that captures the state of sentiment. These ETFs, they just don't rebalance quickly enough with enough frequency that they can capture sort of lightning in a bottle. Meme, for example, when they came out, they touted that they had this 2-week rebalance, that theoretically if they're screening the different message boards that could capture it. Looks like it didn't in this case. The Buzz ETF, it rebalances every month, and if we're talking about memes, it's pretty much a lifetime.
Absolutely. Broadly, though, we are seeing quite a lot of rotation in markets. So how is that affecting ETF land more broadly? If we're getting this kind of rotation happening, walk me through what the implications are.
It's not just memes, that is right. I think the best example is if you look at the biggest momentum ETF out there, it's MTUM. It rebalances twice a year. It's semi-annual, which is, again, a bit of a lifetime. So if you look at what this ETF holds, again, $10 billion in assets, 17% of its holdings are energy. That was the big, theme in markets going into its May rebalance. Roughly 75% of its portfolio turned over from tech to energy. Obviously, that hasn't worked out great in the past couple of months. It's down about 20% year to date. You compare that to the S&P 500, down about 10%. And this, again, it's supposed to be a momentum ETF, but it's missed out on a lot of the gains that we've actually seen.
Also, Morgan Stanley is entering the ETF market. We learned that this week as well. This has been a long time coming, right?
A long time coming. Morgan Stanley, actually, they coined the term ETF all the way back in the 90s, back when, it was just a sparkle in Jack Bogle's eyes, pretty much. So they finally... They're known basically as a big wirehouse, so it's not like they haven't been in the industry. This is the first time that they filed for their own products, though, and it raised a few eyebrows that they filed for 4 ESG funds. And if you look at the flows into ESG products, hasn't been too great, only about $4 billion into that sector this year. That was $30 billion the past 2 years, but obviously ESG pretty much means tech, and it's been a pretty back and forth period for tech right now.
In terms of the size and scale that Morgan Stanley is going to be working with here, what are we talking about?
We're talking about $1.4 trillion in assets under management in their asset management arm. So when I was talking to people in the industry about what does this mean, we see a lot of new issuers come to market. That's been a trend, the siren song of ETFs. No issuer can resist for too long. But just the sheer size of Morgan Stanley coming with their own products, it could mean a potential shakeup of the leaderboard, which is right now dominated by BlackRock and Vanguard.
It's going to be interesting to see what happens with price around all of that. Katie, great stuff. Thank you very much indeed. Katie Greifeld joining us on what's happening in ETF land. Of course, you can get much, much more. Tune in to ETF IQ each Monday, 1 p.m. New York time. Coming up, supply chains are still crimping the bottom line for a bunch of companies around the world. We've just been hearing from Deere. The call is ongoing. We're going to dig into what is happening here. Craig Fuller, FreightWaves CEO and founder, joining us with the numbers next. This is Bloomberg.